everybody? Welcome to the NTC podcast. This is for July 30th, 2019. Just a market wrap of what happened in the markets today. I wanted to make this video tonight because tomorrow is Fed Day. This is the day that traders are calling the most important day of the year. So let's get right into it. In front of me, I got a chart right now. This is the same one we've been looking at now. This is the Dow Jones Industrial Average. As you can see, negative divergence still in place. Got a higher high than here, but we have a lower high on the MACD. And one other thing I want to look at here is gold. This is actually the S&P Gold Spiders ETF. But this thing just has a real nasty negative divergence here. We, again, a higher high, and we haven't even begun to put in a low yet. So I just want to throw this out there. The market, everybody is pricing in a 25-point basis cut for tomorrow, which in all likelihood it probably could happen. But what if it didn't? What if it did not happen? That would be the catalyst for these divergences to play out, because the divergences start to form, the news always follows. So if we did not get a rate cut tomorrow, if they decided to leave rates alone, these divergences would definitely play out, because the market would pretty much shit itself and gold would do the same. So that's what I want to say about that. Now, as far as, I'm not making any predictions on it. I don't have any positions in here from my last video. I was short Google into earnings, closed that trade out this morning with a beautiful profit. And the only trade I was in today was I shorted Twitter pretty much all day long, closed it out towards the end of the day, small profit, that's it. I have some lingering short positions, very small, nothing major. Again, whatever the outcome is tomorrow, it's not going to affect me that much, so I'm not too worried about it. I will be waiting to see what happens tomorrow, and then go from there to see if we're going to put in a bigger position, either long or short, depending on whatever it is. Okay, next thing I want to talk about is, man, I've just been watching a lot of, I got a lot of respect for the guy, Peter Schiff. And he did a podcast, actually a live stream last night called, it's inflation, not deflation. So I listened to part of it. It's 3 hours long. I couldn't get to the whole thing, but from what I listened to, he is making the argument for hyperinflation. And my stance on everything. I'm a deflationist. I do not believe we're going to see hyperinflation. We're going to see deflation first. If we are going to see hyperinflation, we're going to see massive deflation first. Nobody's getting off the hook. Nobody's getting a free pass. I don't buy it. Anywhere I look at through history, I just cannot see that being the case of that happening. But one thing is that why do I think we're going into a deflationary scenario? This is why they're going to lower interest rates tomorrow, if they do. Okay, you have to get out and spend money, guys. You have to be buying houses. You have to be out buying cars. You have to be out charging up that credit card. That is how currency comes to existence. That's how currency springs into life. Okay, so as the economy starts contracting, meaning people start losing their jobs, businesses start laying people off, shutting down, okay, that is a deflationary scenario. So what's going to happen? You're not going to the bank. You're not taking out a loan. You're not charging out that credit card. You're not buying a new car. All right? So we understand that money comes from bonds. All right? They monetize a bond. Money flows through the system. All that money that comes out the bottom, I just call it, I have a diagram here, and the way I have it set up is a flow chart, and it comes out the bottom. You have one side public, one side private. The private's going to be interest, the public is going to be taxes. All this money rises back to the top to pay these bonds. All right, so if we're not taking out loans and we're not going to the bank, all right, so the machine starts to slow down. All right, but on the other end of this, these debts are being paid off. Whenever debt is paid off, currency is destroyed. And that's what these people are not understanding. All right. So as we slow down, debt begins to get paid off. No new debt, because remember, this has to grow exponentially. Okay, the debt load has to grow exponentially year after year. If it does not, that's where you get a contraction. That's where you get deflation. All right. That once currency is destroyed, it makes the remaining currency in circulation that much more valuable. That's why I'm very, very not, I don't want to say positive, but that's just why I have a strong, strong belief we're going to see deflation, and the dollar is going to go up in value. It's going to go immensely up in value as prices fall, meaning you'll have more purchasing power for your dollar. All right, I like to think of it like this. Okay, this is the Federal Reserves. They talk about their 2%, 2 to 3% yearly target of inflation. So think of this. Think of a swimming pool. All right, an above ground swimming pool. Throw a garden hose in it. Let it fill up, and keep it on, and let it overflow. And you'll notice with the garden hose on, eventually the pool fills up and it starts to spill over, just gradually, because it's only a garden hose. And I mean, you got a 15,000, 10,000 gallon above ground swimming pool. So you're not going to get a whole ton of overflow out of it. It's just going to be a nice overflow, but it is going to overflow. All right. What happened in 2008, okay, picture that scenario, but throw a bowling ball through the side of the pool. All right, that's deflation. Okay, you got all this water rushing out. All right, we haven't corrected that deflation from 2008. So what's happening now is that this garden hose is not enough. All right, they got a damn fire hose in this thing. All right, you still have that leak out the side, but the fire hose is just barely enough to eke out the flow of the 2% inflation that the Fed is looking for. This is the best, easiest way to describe this of what is happening right now. Everybody sees they're printing money, they're printing money. They can print all the damn money they want as long as it does not end up in the hands of the people chasing more goods, driving prices higher. You're not going to get inflation. All right? Because remember, we got this big hole in the side of the pool. All this water's pouring out. So instead of fixing the hole, well, you can take the garden hose out. Let's just throw a fire hose in it. All right, that is what's been happening for the last 10 years. Yes, we're getting growth, but not the type of growth we should be getting. So that is my thesis for deflation, and that's what we're fighting. And in my opinion, it's only going to get worse. I have just a chart up here. This is the St. Louis Fed's money velocity, the velocity of the M2 money supply. If you can see right here, it was last updated Q1 of 2019, so 3 months ago. But look, it's at all-time lows. This is not hyperinflationary. Okay? Again, if you watch my introduction video when I talked about electricity, and how it's DC current, how it is pretty much the same. That's the same way that currency works. Okay, look at the velocity of money. Think of that as amperage. All right, and the supply of money behind it. Think of that as voltage, and then the pathway through which the money flows is resistance. This is just Ohm's law. It's easy to understand this. Right now, you have amperage is falling off a cliff. Yeah, there's a ton of money behind it, but what kind of damage is that going to do? Think of it this way as well, okay? You want to put the electricity theory to work here. Voltage is pressure or weight. Amperage is speed, current. And the pathway, the wire through which it travels through, that's resistance. You have to have all three for electricity to work. Money's the same way. All right? So you got the pathway, which is people. That's the resistance, the speed at which it travels, and the voltage, the amount of money behind it. Yeah, we got a crap ton of money behind it, but it's not moving anywhere. It's not going anywhere. It's not doing any damage. Now, the amount of money that they've printed up, if that did get out into the system, meaning just handing it off to people, giving people free money, well then yeah, you're going to see the amperage tick up because that stuff's going to be flying through the system like crazy. It's not. It's at all-time record lows. And it just looks like it's going to keep going lower. I mean, the only way at this point now, this chart tells you, this chart is telling you exactly that people are not going to the bank to take out loans. That's why we have QE. That's why we had, I should say, had QE. I think we still have it going on, but okay, somebody's got to monetize these bonds. Okay, if the general population is not going into debt at the levels they were back here in 2000, or right before the dot-com bubble and right before the housing crisis, okay, you can see these charts. People were going into debt. Look at it; it's right there. Well, ever since the housing crisis, again, it's just been falling flat, straight down. There you go. There's that hole in the side of the swimming pool, just draining out. So if people aren't going to go to the bank, if people aren't going to take out loans to spring new currency to life, then yeah, the Federal Reserve is going to start monetizing the debt to get it happening artificially. So that's my theory behind this. The whole inflation deflation thing. I don't see hyperinflation happening. Just not at this point in time. Now, let's see what happens tomorrow. It's Fed Day. Let's hear, let's see first off what they do with rates, and then let's hear what Powell talks afterwards. And that'll give us a clear indication going forward of what's going to happen. But, I mean, what does it mean? We're at all-time highs on the market. All-time highs. I mean, we're down 23 points today. We're at 27,198 on the Dow. Okay, maybe just a hair shy of all-time highs. Trump was on the news today. We got the best economy in the world. Record-breaking economy. Why the hell are we cutting interest rates then? Why? What's the need to do it? Because it's not the greatest economy in the world. It's not. And this is the reasoning of them cutting interest rates, is to entice the general population to get back out there and spend money. But unfortunately, the general population is tapped out. They cannot take any more debt on. We've reached what I call peak debt. So that's what I got tonight, guys. I hope you enjoyed it. Share this video if you thought it was important, and I will probably definitely put out another video tomorrow since it is going to be Fed Day, and let's talk about what they accomplished at their meetings there. So like I said, as of right now, no really open active trades. Like I said, just some old shorts I've been hanging on to. Still got them. Not worried about what happens tomorrow with the decision. So going forward, maybe hopefully tomorrow we'll pick up some new positions, long or short, doesn't matter. We're gonna play the direction this thing's gonna go. All right, guys. Until next time, we will talk soon.